Before we get started, just want to give you a little background on myself for those of you who have not met me before. My name, of course, is John Vento. I'm a certified public accountant. I'm also the president of Comprehensive Wealth Management, a New York City-based CPA firm as well that specializes in working with dentists across the country. I'm insurance licensed, I'm securities licensed, pretty much anything investment, tax, accounting related. If it's financial related, I got you covered. Throughout this presentation, I'm going to encourage each of you to take notes. Note down what your question is so that you'll have an opportunity to reach out to me and speak with me about what your particular question was. Please call my office. Contact information is at the bottom of the slide. Now, what about your children? Should you employ your children? The answer to that is yes, you definitely should. I know my children, when they were younger, they all came to work for me at a young age. Not only did I teach them responsibility and what it meant to work and earn a salary, which is very important to learn the value of a dollar, but also made them more responsible in that they had to show up to a job every week. Clearly, the hardest part is making sure they show up, right? That's always the tough part because the children have to actually listen to the rules of the game. But the reason you want to employ your children is because they could earn up to $12,400 per year based on the relatively new tax law, completely federally tax-free. So what does that mean? If you have 3 children that work in your practice and you make the mistake of not paying them a salary, what you're doing is you're losing out on a tremendous possibility here. If you paid them each $12,000 each, that's a $36,000 tax deduction that you're losing. What does that $36,000 tax deduction mean to you? Well, if you're in the top tax bracket and giving the government half of everything you make, that $36,000 tax deduction just saved you $18,000. On the flip side, your children now will have to file their own tax return, but if they earned under the $12,400 threshold, they'll pay 0 federal income tax. There may be some state and local tax depending on what state you're from, but the majority of the tax will be not there if their income is under this limit. Very, very powerful strategy if you could take advantage of it. Okay, so to continue on this line, same thing. What is the negative? Well, the negative of employing your children is that now you're going to be paying their Social Security tax. Social Security is 7.65%. That includes the Medicare portion, half paid by the employer, half by the employee. In this case, it would be your child. But even if it cost 15% or so in those type of payroll taxes, that's an awful lot less than what you'd be paying at your own tax bracket, which is probably going to be closer to 50% when you take everything into consideration. On that same note, a special rule that is not known by many people, and I've seen this one skip by people, is right on the board, and I'm going to read it to you right now. So if you operate your practice as a sole proprietorship, as a single member LLC or a partnership, for tax reporting purposes, the wages you pay your children also avoid Social Security and Medicare tax if they're under the age of 18. Furthermore, if they are under the age of 21, their wages are not subject to food tax. A lot of people aren't aware of this, so what I would ask you to do is if you are employing your children under one of those entity choices, you need to make sure when you pay them, you notify the payroll company, not only notify them of their age, but the fact that they're your children and the fact that they're exempt up until this age. If you're not bringing that to the payroll company's attention, chances are you're paying unnecessary Social Security as well as food tax on behalf of your children. So hopefully you're taking a lot of notes here, and most of these tips, you're going to hopefully go back, speak to your own personal financial advisor, your accountant, and ask them, can we take advantage of this? Or even better, have we been taking advantage of it? If you have not, please try to do so sooner rather than later. So let's assume now you did pay your child $12,000 for actual services rendered. The question is, what are we going to do with that $12,000? Well, I'm going to read this slide and then explain it to you. Your working children could fully fund the maximum annual contribution of $2,000 per year to a Coverdale account, which will shelter investment earnings for future tax-free withdrawals to cover college costs, private school, pre-K, elementary, middle school, and high school. If your income, not your child's income, is above the below limits, you will not qualify to contribute money to a Coverdale education savings account. So the point here is that in all likelihood, you as the dentist who are making well over $190,000 a year as a married couple, you cannot put money into a Coverdale savings account because your income exceeds the limit. Your child, on the other hand, based on their income, as long as it's under those thresholds, which I'm sure it will be, they could put $2,000 away each year to a Coverdale account. The Coverdale account allows your child to put money away from the salary you paid them during that year. Any income they earn on that throughout their lifetime will be tax-free, but it must be used to pay for education costs. The good thing is you could even use this for high school. So let's say your child is in public elementary school. If you're planning to send them to private high school, you could use it for that, or you could just keep it there. My suggestion is keep it there longer, because the more it stays there, the more it'll continue to grow on a tax-deferred basis until they're ready to go to college, and then use it to help supplement their college savings cost. So that is clearly a good strategy. And to go hand in hand with that, the next $6,000 that your child earns, what are we going to do with that? We're going to fully fund a Roth IRA account for them. Now, some of you may be saying, why would I want to worry about my child's retirement when I'm still worrying about my own? Well, I'll tell you why. If you put $6,000 into a Roth IRA account from them, and again, that money has to come from their bank account, from the money they earned working for you or someone else for that matter. Let them put that $6,000 into a Roth IRA account each year. Any money they put in is not tax deductible, but all future growth will be tax-free as long as it's taken out during their retirement years. But how can we use this as a retirement saving strategy as well? I'm sorry, not a retirement, but an educational saving strategy. Well, your child could put away $6,000 a year. Let's say they do that for a period of 5 years. They've now accumulated $30,000 into a Roth IRA account. Let's assume that with some good investing, that $30,000 is now turned into $60,000. Your child will be able to use that money. They could pull it out before the age of 59 and a half when they're in college. They could use that money to pay for their education costs. A few things. The initial money they put in comes out completely tax-free. Any earnings that they earned over that period that they contributed, those earnings will come out to them. They will pay tax, but they're now going to pay tax at their lower rate. Not your much higher rate, but their much lower rate. Furthermore, one of the exceptions to the penalty, typically, as most of you probably know, is that if you withdraw money from a retirement account, generally you have to pay a 10% IRS penalty for early withdrawal. Well, one of the exceptions to that 10% penalty is if you're using that money to pay for higher education. So you don't typically think of a Roth IRA account as a method to save for your child's education, but clearly we could utilize it in that way. I'm hoping you don't need to use that money for their college education, because if they continue to put money away into a Roth IRA and they're doing it at a very, very young age because they're working with you, I could just imagine what that money will accumulate to by the time they are ready to retire. I think if they're disciplined enough and are able to do that for, let's say, 30 or 40 years, they could easily accumulate $1 million or more in a retirement account. But what's even better is every penny that comes out of that account throughout their retirement will come out completely income tax free. So I would encourage you, if you're in a financial position to pay your children and have them come work for you, get them working, teach them some basic rules about money and responsibility, and also help them start saving and investing towards their future. Whether you decide to use it for education or their future retirement, that's going to be, of course, entirely up to you and your child. So, what about college-age students? Well, let me read this slide to you, and then I'm going to give you a nice example. If you have college-age children that work in your practice, be sure to pay them the highest reasonable salary for the actual services rendered. Do not claim any college-age children as your dependents if their salaries are sufficient for them to be considered independent. Have them pay for their own college education and living expenses. Well, if your child is working for you, and let's assume they're in dental school, and I'm going to give you an example right now, actually, because that's the best way to explain something. So several years back, I was at a study club. I was lecturing on various topics, including this topic, and one of the dentists took me on the side at the end of the lecture and said, John, I have my daughter. She's in dental school. She does come home 3-4 months out of the year, and she literally works a lot of hours for me, 30, sometimes 40 hours a week in my practice. Number one, because I could use the help, but also because it's a great way for her to train and prepare to eventually become a dentist. And to my surprise, he told me he's not giving her a paycheck. She's just working there for free. Well, I have to tell you, that was a huge mistake. Number one, if you pay your child, that's a tax deduction for you. And your child, yes, they may have to pay tax on that income, but it's going to be a much lower rate. So jumping to the next slide, just to emphasize the point, you as a dentist making $200,000 or more a year, if you're paying for your child's college education, you're paying for their dental school, you cannot take a tax break. You will not receive any tax benefit by claiming your child and paying for their tuition. Not a dime. Your child, on the other hand, because their income is so much lower than yours, they could qualify for either the lifetime learning credit or the American education tax credit. Depending on their age and whether they're in undergraduate or graduate school, they would qualify for this. So what does this mean? This means that your child who is in college and not your dependent may earn up to $34,500 per year completely federally income tax free, assuming they qualify for the lifetime learning credit or the opportunity education tax credit. So that's a big, big deal. So assuming you paid your child for actual services rendered $30,000 last year, in your tax bracket within your practice, that $30,000 deduction, assuming you're paying 50% in taxes, that just saved you $15,000. Your child now has this money in their hands, plus all the college savings that they set aside when they were working with you when they were younger. So now they're self-sufficient, not only based on the salary they're earning when they're working for you, but also they're paying for their college education with the money they put away in their Coverdale account as well as Roth IRA account, perhaps. So they clearly would qualify for these education tax credits. Can't imagine a better scenario, and most of you, maybe some of you, no longer have student loans, but you do know the pain that you went through to get yourself through undergraduate school and then dental school. And especially today, I think the average dentist graduates with student loans in excess of $400,000. Frightening thought. I think it's completely insane that it costs that much to go to dental school these days, but that's the reality of it. So we really need to sharpen our pencils and come up with the best strategies to help pay for that very expensive cost, whether it's undergraduate, medical school, law school, or dental school. It doesn't matter. We need to find ways to do it in the most tax-efficient manner. This way, you're going to save some money, and you're going to be better off financially in the long run. Again, none of us enjoy paying income taxes. If there are ways within the law that you can minimize that tax bill and keep more of what you make, why are you not taking advantage of this? So this is the cover of my book, Financial Independence, Getting to Point X. I would highly recommend that you pick up a copy of it. It could be ordered through Amazon.com or Barnes & Noble. The book is loaded with useful financial planning tips. In addition to that, the second version, which is the green covered book, has a new chapter dedicated to dental practices and the specific strategies you could use to save more of what you make. So with that said, once again, thank you for attending the presentation. I'd like to wish each of you the very best of success. Have a great day and enjoy.